Hello dear, some of these terms you've already learned, but it never hurts to do a little review. Major and minor currencies. The 8 most frequently traded currencies: USD, EUR, JPY, GBP, CHF, CAD, NZD, and AUD, are called the major currencies or the majors. All other currencies are referred to as minor currencies. Base currency. The base currency is the first currency in any currency pair. The currency quote shows how much the base currency is worth as measured against the second currency. For example, if the US dollar to Swiss franc rate equals 0.9167, then 1 USD is worth 0.9167 Swiss francs. In the Forex market, the US dollar is normally considered the base currency for quotes, meaning that quotes are expressed as a unit of 1 US dollar per the other currency quoted in the pair. The primary exceptions to this rule are the British pound, the euro, and the Australian and New Zealand dollar. Quote currency. The quote currency is the second currency in any currency pair. This is frequently called the pip currency, and any unrealized profit or loss is expressed in this currency. Pip. A pip is the smallest unit of price for any currency. Nearly all currency pairs consist of 5 significant digits, and most pairs have the decimal point immediately after the first digit, that is, euro to US dollar equals 1.2045. In this instance, a single pip equals the smallest change in the fourth decimal place, that is, 0.0001. Therefore, if the quote currency in any pair is USD, then 1 pip always equals 1/100th of a cent. Notable exceptions are pairs that include the Japanese yen, where a pip equals 0.01 pipette, 1/10th of a pip. Some brokers quote fractional pips, or pipettes, for added precision in quoting rates. For example, if euro to US dollar moved from 1.20457 to 1.20459, it moved 2 pipettes. Bid price. The bid is the price at which the market is prepared to buy a specific currency pair in the Forex market. At this price, the trader can sell the base currency. It is shown on the left side of the quotation. For example, in the quote GBP/used 1.390515, the bid price is 1.3905. This means you sell 1 British pound for 1.3905 US dollars. Ask/offer price. The ask/offer is the price at which the market is prepared to sell a specific currency pair in the Forex market. At this price, you can buy the base currency. For example, in the quote EUR/used 1.204555, the ask price is 1.2055. This means you can buy 1 euro for 1.2055 US dollars. The ask price is also known as the offer price. BidAsk Spread. The spread is the difference between the bid and ask price. The big figure quote is the dealer expression referring to the first few digits of an exchange rate. These digits are often omitted in dealer quotes. For example, the US dollar to Japanese yen rate might be 108.07, 108.11, but would be quoted verbally without the first 3 digits as 0711. In this example, US dollar to Japanese yen has a 4 pip spread. Quote convention. Exchange rates in the Forex market are expressed using the following format. Base currency, quote currency equals bid, ask, transaction cost. The critical characteristic of the bid/ask spread is that it is also the transaction cost for a round turn trade. Round turn means a buy, or sell, trade and an offsetting sell, or buy, trade of the same size in the same currency pair. For example, in the case of the euro to US dollar rate of 1.202124, the transaction cost is 3 pips. The formula for calculating the transaction cost is transaction cost, spread, equals ask price, bid price. Cross currency. A cross currency is any currency pair in which neither currency is the US dollar. These pairs exhibit erratic price behavior since the trader has, in effect, initiated 2 USD trades. For example, initiating a long, buy, euro to pound sterling is equivalent to buying a euro to US dollar currency pair and selling pound sterling to US dollar. Cross currency pairs frequently carry a higher transaction cost. Margin. When you open a new margin account with a Forex broker, you must deposit a minimum amount with that broker. This minimum varies from broker to broker and can be as low as $100 to as high as $100,000. Each time you execute a new trade, a certain percentage of the account balance in the margin account will be set aside as the initial margin requirement for the new trade. Great. The amount is based upon the underlying currency pair, its current price, and the number of units, or lots, traded. The lot size always refers to the base currency. For example, let's say you open a mini account that provides a 200 to 1 leverage or 0.5% margin. Mini accounts trade mini lots. Let's say one mini lot equals $10,000. If you were to open one mini lot, instead of having to provide the full $10,000, you would only need $50. $10,000 by 0.5% equals $50.